Joining us now to weigh in, JPMorgan's chief economist, Anthony Chan. Anthony, good to see you.
Glad to be here.
Thanks so much for joining us. So what's your take on the economy right now? You think it's strong enough to warrant a rate hike?
I think that given the fact that the unemployment rate is so low and that the economy is not completely collapsing, does in fact justify a rate hike before the end of the year. And in fact, the financial markets are not anticipating it, and Bill Dudley and others at the Fed certainly want to change that.
What about the issue that businesses are not spending? I mean, we see it through the factory orders numbers, we see it through business investment numbers. Businesses are sitting on cash. And
there's a good reason for that, Maria. Productivity is so low. It's now down on a year-over-year basis. In this environment, there's not a lot of incentives for businesses to actually spend. We've had 3 consecutive quarters of negative growth on an annualized basis in capital equipment expenditures. We need to see productivity picking up. We need to see greater opportunities for business before that happens.
And yet, Anthony, even though you're seeing what Dudley said yesterday, there are clearly mixed signals still coming from the Fed. John Williams, the San Francisco Fed president, indicated, who's seen as pretty close to Yellen, seemed to indicate again yesterday that actually even though there may be a rate increase, 25 basis points possibly this year, the Fed is still very, very reluctant to do any kind of normalization of interest rates. You've seen the dollar, as a result, falling, particularly against the yen. There's no, even if they raise rates, even if they do move towards a long-term normalization, it's going to be extremely slow, right? There's no suggestion.
I would not call it even a normalization, because all we're talking about is 25 basis points sometime between now and the end of the year.
Right.
One of the things that John Williams has said and other researchers have said is that their real Fed funds rate, or the equilibrium Fed funds rate, is much lower
than it has
been.
So
given that as a backdrop, John Williams, as you mentioned, came up with the idea that maybe they should raise the inflation target.
Right.
To me, that seems a little strange, because they can't even meet the current inflation target. Raising it even higher certainly is an even bigger challenge.
I thought yesterday it was almost unusual. Bill Dudley seemed to be sounding a warning to bond investors about the 10-year Treasury, that the yield on the 10-year Treasury at 1.5%, and I'm paraphrasing, of course, but that investors are complacent about that, and that, losses could be on the horizon if you're piling into Treasuries at this point. That was what I took away from what he said, and I thought that was a pretty big step.
Well, I'll tell you what's going on is that the Federal Reserve in this environment never wants to raise rates if the market is not anticipating it. When you look at the Fed futures contracts, they're basically not telling you, they're telling you not more than one rate hike between now and the end of 2017. That, according to many people in the Fed, is completely unacceptable, and they're trying to print the market for a little bit more than that.
And they're totally data dependent, aren't they? I mean, you go from, you have 1 month's good employment numbers, and they start to talk a little bit about the possibility of raising rates. You get another month, where you have, we've had a bumpy few months with the employment numbers. You get another month where actually it doesn't look so good, and then everybody's signaling the rate.
Well, the last
retail sales were garbagey last month.
And let's not forget Europe. Europe is a mess, right? I mean, look at Europe in terms of no growth there. Any expectations that that's going to turn around?
Well, if you look at
emerging markets are still stuck.
If you look at the United Kingdom, there is not going to be any growth in the next 12 months. That's why they've been so aggressive. But if you look at some of the confidence numbers, even the business confidence numbers in the Eurozone, they are suggesting that growth in the next 12 months will be at least 1%, maybe even a little bit more. But no question that there's going to be some fallout from Brexit, even into the Eurozone, less so into the United States. And the further you leave or move away from the United Kingdom, the less the fallout. But there is some fallout.
What do you make of this argument now that you're hearing more widely that low interest rates may actually be harming the economy, that actually the effect on savers with negative interest rates, particularly for the banking sector, that's being hit pretty hard, essentially a tax on banks, that actually that this belief that central bankers have had for so long that you just keep priming the pump with lower and lower interest rates, that actually that may not be working at all?
I've heard that argument many times, and they've said that these low interest rates are causing people to save even more, which slows down the economy, except that in the last savings rate, the savings rate actually went down, so it didn't actually work out that way. And as far as the retail sales numbers, one of the things that I have done in my research is to look at the relationship between retail sales and consumer confidence. And of course, for August, consumer confidence did edge up a little bit. So we are likely to see retail sales bouncing back in August from that dire number that we saw in July.
And the number that we get, the numbers we got from Home Depot yesterday and TJX, there are pockets of strength. But broadly speaking, the retail sales numbers were weak.
On the home part of the story, like a Home Depot, and also online. You have to look at online as a start. Let me switch gears, ask you about another story in the Journal this morning, and that's about this hedge fund battle losses, because people continue to take money out of hedge funds because they're underperforming. And then yet the story here is that there's an exodus. Hedge funds continue to underperform the broader market. The Journal reporting two of the biggest hedge funds, Tudor and Brevin Howard, are no exception. Jerry, talk a bit about this trend. I mean, the average, I was reading the story earlier, the average hedge fund is up 3% year to date.
Yeah, I mean, it's really been a very disappointing couple of years.
Most are a lot worse than that.
You remember hedge funds, people, they're expensive. The old 2 and 20 rule. Now, that's often, more honoured, more in the breach than the observance these days, but they still are. They still charge a very, very high fee for getting what are supposed to be outsized returns. The last couple of years, they have not been getting those returns. There's a view, and I'd be interested in Nancy's view, that there are too many hedge funds. There used to be 200 hedge funds. There are now sort of 15,000 hedge funds. There just is too much of that money chasing those returns, and that they have become, and that they're all, suffering in this incredibly low yield environment. I mean, is that, and our story today, I think what was significant about it is that these are two very well-known, kind of iconic names in the hedge fund sector, Brevin Howard and Tudor, significantly pulling back.
Well, there's no question that in a world where rates of returns are much lower and growth all over the world is much lower, it's a little bit more challenging. But the purpose, I think, of these hedge funds is to diversify away the risk. It's not always to outperform to that extent, but of course with the fees you want them to outperform. But there's going to be a shakeout.
And
no question.
Well, if they're going to charge 2 and 20, they better outperform.
Right, that's the point. Is like that despite being these kind of like gods of the financial universe, they're really just like mutual fund managers. Right. They just charge a lot more in terms of the inconsistency of performance. Like Brevin Howard during the credit crisis did extremely well. Right. Since then, not so much.
Well. Yeah. Right. And with ETFs and all these cheap alternatives,
exactly.
Why should I pay 2 and 20 in a hedge fund if they're not even going to perform? That's what's going on.
That's what's going on. But if you look, as you mentioned before, they tend to do a lot better when conditions are much worse, and they tend to do not as well when conditions are improving, and that's a fact of life.
Anthony, great to see you. Thanks so much.
Glad to be here.
Good to have you weigh in. Anthony Chan, JPMorgan.